Hello, guys. What is happening? And welcome to tonight's live stream. So, I have with me a very special guest. He is on here for the second time. Can't thank him enough for coming on. So, he's been a guest on such big things as Yahoo Finance, Bloomberg. He's the author of many books, one of which is right here, When the Bubble Bursts. And I've left a link below to where you can buy that. You can get it at Amazon. Link is in the description. Hilliard has written a couple of books on bubbles, so he is well educated on this stuff. He puts a lot of great stuff out on his Twitter, and his Twitter handle is HMacB, and you can go there, follow him on Twitter. I've also linked that in the description. So without further ado, I'll bring you in. Hilliard, how are you doing?
I'm doing great. I just saw Top Gun, so it's a great movie. So
yeah, I want to see that actually. It seems
when I tweeted out, I said, well, the plot is not to give it away, but there's not a huge plot, but they have to do this attack with these F-18 fighter jets, off an aircraft carrier, and it's a very difficult approach and very difficult to get back, after they do the attack. So I tweeted out, why didn't they just use drones? So I mean, but then there wouldn't be a movie. It'd be a pretty boring movie just watching these drones go and drop the payload on. So
no, it would. I saw a funny thing with Tom Cruise and James Corden to do with that Top Gun thing. He was taking him up in one of the jets. It was quite funny. But yeah, I'll have to watch that. So first thing I will bring up, Hilliard, is this chart which you posted on Twitter today, and your handle is in your title there, HMacB. So if you want to follow Hilliard on Twitter, his handle is on his name there. So this chart Hilliard posted, and I'll let him explain for you, but fantastic chart.
Yeah. So there's a bunch of stuff going on here, but you can see the three lines that are sort of going vertical right now are the house prices. In the orange line is Vancouver, the top one, and all of these series on this graph are index based to 100 in 2000. So 22 years of data. My associate Fraser Betkowski has put this together. We've been publishing every month for several years now, and so the second line is Toronto. So Toronto and Vancouver. Toronto was way behind Vancouver for the longest time, but the last, I'd say since 2017, it's threatening to catch Vancouver. And then the national average is the third line that's going vertical. It's sort of the dark line there. It looks like it's about 475 on the index. So that's 4.75 times growth in 22 years. And then there's a milder line there. That's the household debt number. And it's grown more than fourfold in 22 years. It's about a 7% annual rate of growth. And then then there's a big gap, a huge gap of empty white space. And then you get down, and it's the lighter blue line is median after-tax income. So that's what people have to use to buy those house prices that are way up at the top of the chart. And then the next line, the sort of mild there, is the shelter index. So what the Statistics Canada calls shelter is what is used to be the proxy for house prices for the cost of housing. So why would that green line at the bottom, there's an arrow pointing to it, the shelter index, be so low when the house prices are so high? And then the last line there at the very bottom, but you can see it's going quite vertical now, is the consumer price index itself. So consumer price index has gone really nuts. And of course, everybody knows in the US, it's about 8.6%. And in Canada, it's coming out next week. It's been edging up towards 7%, but there's some changes in the weighting in the CPI in Canada that is going to bring it closer to the US. They're going to add in some things that there's differences between Canada and the US. So it could easily be 8% next week. So
what are those differences?
Well, it's kind of technical. So and I don't know the full answer to that, but one of the things. So one of the things they have in the U.S. that we don't have is used car prices.
Oh,
but
right.
they're going to add it in now. So, but what I do know is shelter. That green line is kind of the mildest line there. It's been growing at less than 3% a year, and yet house prices have been growing at more than 7% a year. So what's going on there? Well, I think this is something that's not well understood, or even people don't even know about this. But what it is they instead of using house prices, they decided, and many countries do it this way. It's not just Canada. They decided to use a monthly payment approach to calculate the cost of housing. So they use rents, actual rents. They use new house prices, and then they use what's called owner's equivalent rent, and then they use mortgage interest and a few other things. They've all got various weights, and but people don't need to know. They can look it up on StatsCan if they want, or they could contact me if they want. And I've written a couple of things on it in my weekly blog that I do, which I tweet out every Friday. So the most recent one came out today. But the thing to know about it is that they calculate the cost of housing based on your monthly payment. So the monthly payment is either you're renting from the landlord, or basically you're paying a mortgage on a home that you bought. And of course, what's happened is up until very recently, interest rates have gone lower and lower. So therefore, your monthly payments haven't gone up. You buy a more expensive house, four times more expensive over the 22 years, but the monthly payments are not even doubled because the interest rates came down over that same period. So what it did, and I'm not saying this is deliberate. I don't think it's possible that people could have known in advance that this was going to happen, this crazy housing bubble. But what the effect of it is that it's allowed the central banks, not just in Canada but in other countries, to ignore the huge price increases in houses, because in their CPI, the country consumer price index that everybody watches so closely, the shelter cost hasn't gone up much at all. So it's really unfortunate, because imagine if that one thing I haven't said yet, which is important, is that the shelter index, which appropriately is the biggest weighted component of the CPI, believe it or not. So here you've got the CPI with its biggest weight component at over 31%, showing a very mild amount of inflation. What it really should be, if it was tracking the house prices, it should be showing a much more, would be more than double the rate of inflation if they track just house prices. Then there's arguments on both sides as to what they should do, but I think the one thing I know for sure is that inflation would be much higher, and therefore the central banks would have been forced to deal with this housing bubble a long time ago. Probably, if you look on the chart there, probably if you go back to 2010, you'd see maybe not that, but certainly in 2016, 2017, when prices start to really take off, it would have impacted the CPI a lot. I'm guessing between 1% and 2% at least. So instead of inflation being 2%, which was their target, it would have been 3 or 4%, and they probably would have been forced to take some action. So that's one of the things here. The other thing is you can see how little growth there's been in wages after median after-tax income. So it's at about 200 on the scale when the houses are 450, 500, and close to 550. So that shows you how much tougher it's getting for the average wage earner or salary earner to buy a house. And the difference, of course, is made up by borrowing more money. And that's why the mortgage debt, that line that's been growing at 7%, is growing as fast as the house prices. So, I get really annoyed when Statistics Canada, and there's lots of economists that do this too, say, well, Canadians are never been wealthier because the house price goes up, and then they say, well, we're wealthy, so what? There's no problem. And but that's just that's just totally inaccurate, because what's really happening is they're just borrowing more money to buy their housing, and then the house is going up. So they're wealthier, but they're also more indebted, and that's really unfortunate, because when the bubble bursts, which it will burst, because the debts are so large, there'll be a significant number of people. Not all. There's lots of older people like me that don't have huge mortgages on their house, and they benefited the most from this, as everybody knows. But the younger people with the big mortgages will be the ones that get hit the hardest. And even some of the older people, unfortunately, will get caught up in them, because they've been helping their kids and their grandkids buy houses. So they've been giving them down payments, so that'll be lost. But the other thing they've been doing, which is really, I don't know if there's anybody on here that is thinking about doing this, but co-signing the mortgage is a really bad idea, because now you've got all the assets of the parents' generation or the grandparents' generation tied to this house price, which could go down, somewhere between 29% and 50%, depending on whether you take the estimate of the Bank of Canada or other people. So it's that we'll keep putting that chart. Oh, and by the way, one more thing, and then I'll stop talking about this chart. You probably have heard that house prices have been going down now I think we're into the third month of declines in house prices. But if you look at the chart, the house prices are still going up at a very rapid pace. And so what's going on there is there's a lag of about 3 months. So this particular index is calculated based on when the house price, people probably know this already, most people, but it takes 2 or 3 months, or sometimes as much as 6 months, for the land titles department to actually get notice of the sale. And this index, these guys wait for that before they record the price. So there's a lag of, let's say, average of 3 months, and then they take a moving average of 3 months as well. So they're deliberately behind. They're trying to smooth it out, but there's nothing smooth about that. This last year, there's nothing smooth about it. It's got parts of the vertical, but it'll change. Now that the fixed rate on mortgages has crept up close to 5%. It's just under 5%, about 4.85% on the fixed rate. And so once the house prices start to come down, because people can't qualify for mortgages anymore, we'll see those lines turn down, but with a bit of a lag.
Yeah. I think the other thing that's really interesting about the whole housing situation as well is like another lagging thing, which will bleed out eventually, is all the mortgage fraud and everything that's gone on, because people aren't going to be able to afford their homes. And it's also going to have a big impact on the economy, isn't it? Because you've got essentially all this paper wealth that people used to have, and a lot of people living off home equity in Ontario. I've got friends who, they use their house like an ATM, and I'd never seen anything like it until I moved to Canada. People using their homes as cash machines, and I was just like, what? And it was so refreshing in your book, because I didn't realize the Scotiabank ad, "It's richer than you think," came from like advertising home equity line of credits. I didn't know it was coined by that until I read your book, Hilliard, but I thought that was pretty good. But
we were looking, actually, I read about it in the book about our big renovation we did in 2010, and how much, I didn't put the actual number in there, but I put the description of the shock of how much it cost. So we had to get a line of credit, home equity line of credit. And the lender said, well, like you're empty nesters now, and you got 4 bedrooms in your house, but you're only using 1 bedroom. So there's 3 extra bedrooms. And he said, so borrowing against the equity in your house is just like using those 3 extra bedrooms. Think, why have them sit there? This was an analogy that he used. It's like, I mean, what an easy sell for people to say, interest rates were 1.5%, maybe 2%, depending on on the line of credit. This line of credit interest rates are a little bit higher than mortgage rates. They tend to be tied to the prime rate. But I mean, they're giving money away for free. Why wouldn't you take it? Why wouldn't you tap into that wealth that you've created? The whole thing is so scary, and yet one of the most amazing things that's happened is how successfully people have been convinced that it's okay to do that. Like it wasn't that long ago. I guess it's a long time for young people, but 30, 40 years ago, nobody would ever dream. It was called a second mortgage. And it was only like super speculators that were really big risk takers and people that were deeply in trouble. Maybe they lost their job or something that took out a second mortgage. I mean, it was a shameful thing to take out a second mortgage. That was like
wow.
So they've changed it. So they've changed debt from being this kind of shameful thing to being like this super cool, like you're a financial wheeler dealer because you're tapping into the equity, right? You're not like it's not tapping into equity. It's taking on debt. That's what it is. So with those home equity line of credits and the original mortgage, what's happening is some of the baby boomers are actually starting to get to the point. If house prices go down 30 or 40% in this downturn, they'll actually be at the point where they have very little equity left in that, and so they won't be richer than they'll be poorer than they thought, rather than richer than you think. And, I don't know. It's a really sad thing, and I don't understand really why. I like the title of your show, Mania, Market Mania, because when people call it a bubble sounds really kind of fun and like a party bubble, but mania sounds like somebody with a mental illness that might be locked up in an asylum and put into a white coat or something like that. That's manic depressive used to be the term that people used for, and it's almost like people have been caught up in a collective mental illness in terms of the frenzy to buy housing, and that's one of the things that really is unfortunate about this situation. But now we're into it. The prices are correcting. For a lot of people, it'll be the best thing that ever happened because they'll be able to finally afford to buy into the houses if they haven't bought. And for some other people, they'll probably go bankrupt. People that bought in the COVID recession using the money from the government that was handed out so freely as a down payment to buy a second property, some of them may probably end up losing both properties if it doesn't take much of a decline in house prices, maybe 20% for the total equity to be wiped out on those things.
Yeah.
It's but I used to feel bad about that, but I think now I'm thinking, well, maybe that's a good thing in a way, because people will that's the only way people will come to understand that debt is dangerous. I think that's the thing that's got lost in this whole thing, is how dangerous debt is, especially in a bubble, but
yeah, I think you're right about that. And I see a lot of people throwing up on Twitter. It really annoys me, actually. Because there seems to be a lot of blame being thrown around about how last year started. And I guess you could put a lot of the blame on the Bank of Canada, but likely it really came from the government when it started. But regardless of that, people keep throwing up this quote on Twitter, which is like the Bank of Canada saying something quite vague about borrowing money in 2020. Like they came out with this statement, and I believe like it was something along the lines of rates are going to be low for a very long time, something like that. Yeah. So everybody took that and ran with it. And the interesting thing about that, I see lots of people on FinTwit posting it everywhere. Big people with loads and loads of followers like yourself, and they're posting this stuff. But then they failed to mention that in 2021, last year, around March, April, and I posted this, it was that the Bank of Canada actually came out and said, if you think housing prices are going to be this high and keep going up, it's not going to happen. It was very, their words were obviously more delicate than that, but it wasn't as vague as the statement they came out with in 2020. But I just found it so funny that people were referencing that, because it kind of reminded me of how people just kind of, when they hear what they want to hear, they just run with that and do everything. Like, we can just borrow as much as possible. It's music to our ears. But then when everything turns around, they just shut off. They don't want to hear what's actually happening.
The governor of the Bank of Canada a new governor was appointed, Tiff Macklin, not that long ago, but probably about two years ago now, I think. And not that long after he was appointed, maybe it's a little bit more than 2 years. That was right around when COVID hit. So I think he was trying to reassure everybody to say that, because they were worried that with the COVID recession that we were going to go into depression. Mm-hmm. And so the federal government went into deficit by $400 billion, which is a phenomenal amount. It's like, it's not that far off the total accumulated debt since 1867. They did it all in 1 year. Like, it's unbelievable. And so that's one thing they did. That was on that's called the fiscal spending side. And then on the monetary side, they dropped interest rates down so low. And then the governor of the Bank of Canada, unfortunately, said that rates were going to stay low for a very long time, or some wording like that. So people took that to say, well, and then of course the lenders were promoting the variable rate mortgage, because the variable rate was like 1.5%, and then the fixed rate was sort of 2%, or in that range. So you saved another 0.5% by taking the variable rate, and that allowed some people to qualify for a bigger loan, so they could buy a little more house than they thought. So because prices, they didn't come down a whole lot. They didn't come down at all, actually, in 2020. So the just wasn't the downturn didn't last long enough. The stock market went down about 38% in 1 month, but the housing prices didn't really come down at all. So it was really unfortunate. And people bought 2 houses. One of the things I've never seen it explained, but obviously when you had those bidding wars in places like Peterborough and Oshawa, all around, and it also happened in BC as well, in these smaller centers. There was you can't enter a bidding war and put a condition on it, say, subject to the sale of my house in Toronto, right? So you can't bid on a house in Oshawa and say, people would just laugh at you, right? So you have to buy it without selling the place that you currently own. So people ended up owning 2 places, and one of the questions I have about that, which I don't suppose we'll ever get the answer to, is, were the banks actually willing to finance those 2 homes? I mean, that's pretty hard to imagine that people really had the income to qualify for that. So they basically were probably doing what's called asset lending rather than income qualification lending. But I think that's already starting to show up in some of the suburbs of Toronto, that people are caught with 2 homes. And in a recession, like one of the things that just came out a couple of weeks ago was the Bank of Canada did a stress test. So will the Canadian banking system be able to survive a severe downturn? And so they do a stress test, and they used a peak unemployment rate of 13.5%, which was pretty high. I don't think it's gotten that high very often in the last 50 years. So that once you get people with that much unemployment, obviously people that own 2 houses are going to be unable to continue, right? They'll have to, they'll either have to sell one or both houses, or they'll have to maybe go bankrupt, So I don't think the Bank of Canada really believes that that's going to happen, but they wanted to make it look like the stress test was very severe. So they had like a big drop in GDP, 6 quarters, so a year and a half of recession, which is a very unusually long recession. Big increase in the unemployment rate, and a high peak unemployment rate. But then they did something really unusual and hard to understand. They assumed a house price decline of only 29%. So 29% only gets us back to about 2018 or 2019. It doesn't wipe out very much of the bubble at all. And so I found that really odd because they had done a stress test similar to this one 3 years ago, 2019, before COVID, and they used for house price decline, they used 40.9%, and this time they only used 29%. So I don't know where they got that number. It doesn't make any sense. I mean, the house price decline in the U.S. was 38%. It took 4 years from 2006 to 2010. They should have used at least that number. And I think 40, almost 41% was probably a good number to use. Somewhere around 40%. It's a good. It'll probably be a little worse than that, but 40% is good enough. 29%, doesn't seem
no.
So maybe they wanted to come up with the answer that the banks would survive, right? So now the other thing that people should know about that, and I was pretty surprised to see this as well. In both the 2019 stress test and the recent one just 2 weeks ago, they assumed that everybody that has a mortgage would keep paying the mortgage. Nobody would stop paying the mortgage. And I mean, on the one hand, that's understandable because generally that's what people do in Canada. They'll do everything. They'll sell all their cars, all their skidoos, all their sea-doos, and everything else before they'll stop paying their mortgage payments, right? So the only way to get out of your mortgage payment in Canada, unlike the U.S., is to declare personal bankruptcy. So it's generally people don't want to do that. So I guess it's a reasonable assumption, but I don't know. In this housing bubble with this amount of debt, I think there will be some people that decide to take the personal bankruptcy route, and then the debt's wiped out. You can start over. So I know in the U.S. I was surprised. In the U.S. about half the states allow you just to walk away from your mortgage in the U.S. It's not like Canada where you're on the hook for it. But even the people that had the right to walk away from their mortgages in the almost 40% decline in houses in 2006, 2010, a whole bunch of people that could have walked away did not walk away. They kept making their mortgage payments, and probably not a good financial decision because they had the right to walk away. They should have just walked away.
Yeah,
because they're paying a mortgage that is bigger than the value of the house, so they're upside down on the mortgage. But I think there's kind of a feeling of shame if you do that, if you walk away, if you renege on a debt or something like that. So people stick it out. They just say, well, price will come back. I'll just keep paying the mortgage payment until it comes back. But if you got $1 million house in Toronto, it goes down to 600,000, a 40% decline, and your mortgage is 900,000. Yeah. That's going to be a long time for it to get back up to 900,000, which your mortgage payment is. So depending on what other assets you have, but if you have very small assets outside the house, then people should probably examine the alternative of going through a bankruptcy. And the terms are not very onerous, and there is a stigma attached to it, but eventually you and there's a little asterisk beside your name. It's hard to get credit for a few years afterwards, but 300,000 it's a lot of money after tax. Most people would take after tax. It's probably 10 years of savings, right? And that's only to get back to break even, right? So before you even get any gains on those houses. So no, we're not there yet. So obviously it's a theoretical thing at this point. But some people should. I would recommend that they get quite hard-nosed about it. The question to ask is, what would Goldman Sachs do, right? So would Goldman Sachs, if they had the legal right to get out of an obligation like that, would they keep paying it out of some sense of moral duty, or would they just use every legal measure to get out of it? Well, we know the answer to that one. So.
Yeah, and I think it's only like Alberta and Saskatchewan where you can just walk away, and even then it's a black print on your credit score. But I believe those are the two provinces that you can just walk away when I looked into it.
Yeah, you can. In the Great Depression in the 1930s, because so many farms were being lost to foreclosure, that was the Eastern banks. There was a whole political movement that started called social credit that came out from that. Anyway, it's the Alberta there was a guy named William Aberhart that was the leader of that. And so they passed a law that said you can walk away from your mortgage if you want in the 1930s. But what happened after the 1980s, when a lot of people did walk away from their houses, is Alberta brought in some different, they modified the legislation. So the legislation is still there on the books, but most people, when they look at the fine print on their mortgage, they'll probably find that right is no longer there for them. If it's a CMHC mortgage, for example, you don't have that right. You don't have that ability to walk away. So that's any kind of mortgage insurance. So about 60% of all mortgages are mortgage insured. So that takes them out of the equation. And then depending on what the other terms of the mortgage are, you probably would have trouble walking away. So it's going to be a very small number of people that actually are able to walk away. It has to be conventional mortgage. And so most of the people that are really high debt people, they won't have that provision where they can walk away. So they would be on the hook for the deficit. And so they'd be in that situation where they have to decide if they want to pay off the deficit over a long period of time, or whether they want to try and get out of it by going through the bankruptcy procedure. But we're not there yet. So
no. And you mentioned CMHC, and it's something you write about in your book, and I thought it was great because you call it what it is, subprime. Essentially, it's just Canada's version.
Yeah, the subprime mortgages in the CMHC are, of course, they're not called subprime because they're guaranteed. I really wonder how many people. It's an amazing thing, because the home buyer actually pays the insurance premium, which can be $15,000 depending on if you put the minimum. The minimum is $5,000 down, or 5% down, so it'd be $50,000 on $1 million home. But there's also a CMHC insurance fee, or there's another insurer, private sector insurer, which goes by the name of Sagan now. Used to have a different name, but got taken over by Brookfield. and there's quite a big fee, but it isn't the bank or the lender that pays that fee. It's actually the home buyer that pays the fee. And so I think some of those home buyers might think that somehow that insurance helps them, but it doesn't have anything to do with them. It just helps the lender. So what that means is this government program is there because the lenders would say no to those people because they're too risky. If they didn't have this government insurance program that, if anything goes wrong, they can just turn to the government and say, okay, bail us out because we lent to these subprime borrowers, right? So it's a way in Canada we have of not facing up to reality, sort of sweeping it under the rug and pretending that there is no subprime. But obviously there's a lot of subprime. And the other thing that's interesting about all that, when I dug into it when writing the book, was that there's also a government guarantee on the private sector insurance as well. So the private sector, I don't know how that happened. That would be a really interesting project to research, and if you could find out how they convinced the government to put a guarantee on that as well. But there is, and of course, I guess I could guess what the reason is that there's no way that an insurance company could afford to take a risk of insuring houses and mortgages without some kind of government backing. So the government's into it up to their eyeballs, and the banks are protected to some degree. But having said that, the banks have still got a lot at stake because even with the insurance, a lot of the mortgages that were written in the last 3 or 4 years, these are the riskiest mortgages because of the house prices being so high. Were not guaranteed by insurance. They were conventional mortgages, and the reason they did that was because the qualifying, once you have a 20% down payment rather than the minimum 5% down payment, the qualification rules are not as stringent. So what people obviously were doing was they were going to the private lending market where the interest rates are like 15%, borrowing the 20% down payment, and then even though you're not supposed to do that, and that would be, you could say that's fraud because you're supposed to have saved up that money. But I find it hard to believe that there's that many people that have saved up $200,000 to buy $1 million home. So they either got it from the parents, the grandparents, or they borrowed it. And so there's trouble. No matter which of the three scenarios, there's going to be a lot of trouble in the And the fraud. I looked into the fraud. I didn't talk about it in the book very much because it's very hard to get any real data on it.
Mm-hmm.
But it obviously is out there. I mean, there was an alternative lender called Home Capital in about 2017 that got into trouble. I think it was 2017, somewhere around there, with fraud. There were some mortgage brokers that had bought mortgages where the applications had some fraud in it. It was somehow caught, and they were going to probably go under. But then Warren Buffett came in and rescued them, which is another whole story. Nobody knows. I mean, there was a story told why he did it, but it doesn't make any sense at all because his company is $700 billion. They have $160 billion in cash, and he said repeatedly over the last 10 years that he's not even interested in deals that are smaller than 10 or $20 billion because it doesn't move the needle for him.
Mm-hmm.
And here he comes in and guarantees a loan of $1 or $2 billion on this. It was unbelievable. So obviously he did it as a favor for somebody, but nobody really knows the story. And then Home Capital said they were going to do a private investigation as to what happened in terms of the amount of fraud, and then they never released the results of the investigation. So and then house prices went up, so it kind of all went away, But when I looked into it for writing the first edition of the book, there was talk about mortgage fraud, but the RCMP called it fraud for shelter. So they felt that when people committed fraud for shelter, because they have to live somewhere, that it was somehow less of a crime than fraud, to defraud somebody of money that somebody had. And really, who's the victim in fraud for shelter, right? They just say, well, the lender is the victim, I guess the banks, and the banks haven't really had that many defaults. So
no,
maybe it's the fraud isn't as serious as it would be if somebody was doing like a pyramid scheme or something like that. So that's one thing. And then the other thing is the RCMP just does not have the staff. I mean, if they don't have the staff to go after all of the money laundering that's going on, there's no way that they have the staff to go after people, lying about their income on a mortgage application, which I think is most of the fraud is probably people lying about their income on the mortgage application. And I love what they do in Germany. I don't know if you're aware of what they do in Germany, but
no.
Well, you go into the apply for the loan, and this is all secondhand, but from a reliable source. And you go in and you apply for the loan, and the first thing is they talk about 30 or 40% down payment, not 5%. And I talked to one German guy, and he just couldn't. He laughed, and he was falling off his chair laughing. He said, "You're telling me that you guys only asked for 5% down payment?" And I said, "Well, what is it in Germany?" "Well, 30 or 40%." But it doesn't stop there. So the bank is entering into a relationship with the home buyer that's going to last 25 or 30 years. And so one of the things they want to see is they want to see how much money you save every month. So they say if you can't save money every month, so you've got your income, then you got your expenses, you got your rent, you have to prove to them that you can save money every month. In other words, you'll be able to pay the mortgage with that money that you save every month, or else they won't grant the mortgage. And they want to see a demonstrated ability to save money every month over a period of several years before they'd even consider you as a mortgage. So as a result, what happens in Germany is only about 40% of the people own their own homes, and the rest of the people are rent. And there's very strong laws in place to protect renters from landlords. So the renting relationship tends to be a long-term relationship, and some people rent for, some fairly wealthy people rent their housing accommodation for their whole lifetimes. They never buy. So that seems like a sensible approach. And guess what? House prices, at least until recently, there's a little bit of an uptick recently, but house prices have been pretty flat for the last 40 years in Germany. They never really changed very much. So I guess that's a better approach than what we do.
Yeah. I'm still here, by the way. I don't know what's happened to my camera. It just stopped.
That's okay. Yeah, I could hear you. Yeah.
Yeah, I'm still here. It's just the camera. I don't know what's happened, but that's okay. One thing, because you were talking about CMHC and everything like that, I thought I'd mention that when I was looking into the fraud and everything about the fraud, it came up time and time again that one of the most common situations that I was seeing was people lying to get a CMHC sponsored mortgage for a rental property. Like they were saying that it was almost like, just accepted that this was a thing that people did and it was perfectly normal. And I wondered if you knew that, on what your thoughts were on that, because it's kind of not really talked about that much apart from people on Reddit and places like that, which I found.
So what you're saying is that people are planning to become an investor, but they're portraying their purchase as if they were going to move into the place themselves and be a owner occupied property.
Yeah, exactly. So they would lie on the application and say that we're going to live in the place, and then they would they'd just be a landlord. They'd be renting it out or whatever.
Well, that's interesting because some data just came out recently saying that 1 in 4 people of the recent purchasers of homes have been investors, which is a very high, 25% is a very high number. But I talk to some people and say the number is probably quite a bit higher than that, because there's an incentive to lie about the financing that you get, which is sort of reinforcing what you're saying. The financing you get is on better terms if you say that you're going to be owner occupied rather than buying as an investor. And that's one of the proposals they have, is to put more onerous requirements on investors versus. So all that's going to do is the incentive to commit fraud. And again, it's a soft fraud in the sense, well, I moved in for a few months and I changed my mind and then I rented it out. Well, who has time to question whether that's true or not, or it's just one of those things that's never going to get chased down really, because as mentioned earlier, they don't even have the staff to go after major money laundering that's happening, China, people coming in from other countries like China, and those things with very large amounts of money. One estimate, just into Vancouver alone, was in the billions of dollars of money laundering. So if they can't get organized to go after that, they're not going to get organized to go after some guy that say, well, I'm not really an investor. I'm going to live in the house, and then he changes his mind at the last minute. How could you prove that he didn't honestly intend to be owner occupied, and then he changed his mind, or he had to change his mind? Maybe something happened, and that would be very difficult to track that. But there's another wrinkle to that came out. Reminded me, I didn't mention that, which was that, and this is not widely understood, is that CMHC doesn't have their own lending department. So they use the banks, like the banks are the lenders. CMHC is just the insurer. So they rely on the banks to do all that due diligence, to do what they call the underwriting of the mortgage. And so when the bank says, okay, this guy defaulted on this mortgage, it hasn't happened a lot, but it will in the near future probably, then the first thing that the insurer does, the CMHC and the private insurer does, is before they pay the claim, because they don't want to, like every insurance company wants to deny the claim if they can, they go to the bank and say, show us the file. Let's see what your research was as to whether this person was a good risk or not. And if there's any problem at all with the file, and there will be problems with some of the files, then they deny the claim, right? So the bank is actually, so then the risk goes from the CMHC back onto the bank if they made a mistake on the, and one of the things that I think is really unfortunate about all this is, and this came out in the US in a complaint with Wells Fargo, that the employees of the bank were under so much pressure to make their bonus payments, to make their targets that they were creating fictional accounts. Now, this is in the US and California, Wells Fargo, not in Canada. And the Wells Fargo got into really big trouble and a whole bunch of fines and stuff. And so then they asked, so some of the Canadian employees of Canadian banks said, well, we're doing that here in Canada because we're under so much pressure to meet our targets that we have to take very aggressive measures to get the number of mortgages and HELOCs and credit cards and all that sort, just like what was happening in the US. And so the government, it was a CBC report. And so the government asked the banks to investigate to see if that was happening in Canada. And the banks did an investigation. They reported back to the government that they investigated and but no, it wasn't happening in Canada. But I think when humans, when you get it, but it doesn't make any sense to have bankers bonused on increasing their volume of loans they put out every year. And if they don't make a certain target, they lose their bonus. It shouldn't be like that. There shouldn't be sales people selling debt. They should be more like the German approach, where they're very skeptical and say, well, prove to us that you deserve to get this loan. Kind of, that would be a much more sensible way to do it. But then the banks wouldn't have the growth that they've had. You saw that chart we had up at the beginning of 7% annual growth. And that's the revenue of the banks going up 7% every year. And remember, for the total mortgages to be outstanding to go up 7% a year, the new mortgages have to be much bigger than 7% a year, because everybody that has a mortgage is paying down the mortgage by a certain amount every time they make a mortgage payment. So the repayment of let's say the repayment of mortgages is 5% a year. There's a tremendous range depending on how old the mortgage is and how much down payment people have and stuff. But let's just say 5% a year just for fun. That would be about a 25% mortgage or 25% amortization roughly. Let's say 4% then. So let's say 4% a year. So for mortgage growth to grow at 7%, you'd actually have to have new mortgages of 11% a year to have a net 7% annual growth in mortgages. That's how fast people are getting into debt. So that means the banks have got a lot of salespeople out there that are called bankers. They're really salespeople. Going to people and saying, can we give you a loan? How much can we give you a bigger loan? How big a loan do you want? And trying to push debt onto people. And it's so unfortunate. It's become normal in our society, but I think it's gotten us into big trouble for sure.
Yeah, no, it certainly has. And do you think it has to a certain degree, but once we start to see the recession, the defaults, the credit contraction, obviously the banks have to become more analytical of risky people, and credit conditions are bound to change as a result. I mean, in the UK where I'm from, Hilliard, after 2008, trying to get a mortgage was an absolute nightmare. Most of the banks were in public ownership, like you said in the last video, and to get a mortgage was tough. They wanted, sometimes 50% down payment minimum. And this was in the prior 3-4 years after it, where they were suffering huge losses still from that. And if you wanted an investment property, well, they would just laugh you out of the bank unless you had somebody you knew who was willing to put their house that they owned outright. So no mortgage. They wanted people with assets that they owned outright to put them up, put a lien on it, so you could get a mortgage on an investment. It was just nuts.
Yeah, actually, every bank in England or in the United Kingdom went under that was involved in housing. The one bank that didn't go under, that didn't become a ward of the government, was Barclays. And but Barclays committed fraud, so they well, at least they're accused of it. They didn't get convicted, but what happened was they went to I think it was Qatar, one of those Middle Eastern countries like Qatar or Dubai or United Arab Emirates. They gave them a big loan of billions of dollars, and then that country bought a stake in Barclays Bank, and that saved them from going offside on the amount of equity that they're required to have. or they would have ended up in the arms of the government as well, but they managed to escape it. So, I mean, the thing is that banks, there's this, especially with Canadian banks, there's this mythology that that the banks are very conservative, but they're not. They're very, very highly levered because I explained it in the book. They're measured on the return on equity. So the return is the profit and the equity is the capital base. So if you want to get a return on equity, the Canadian banks are known for having really good return on equity of 15-20%, which is very high compared to the US banks. You have to keep the equity as small as possible. And the regulators go along with this because the Canadian banks have not had a major financial crisis ever for, since they've been regulating the banks, which started in the mid 80s. So if there's a crisis, then what happens is the government cracks down on the banks and says, we got to have much tougher rules. But gradually the Canadian banks have been able to push back against the regulators to say, we shouldn't have too heavy a hand on the regulation of the Canadian banks because we've done so well. And that's, and so it's kind of like, it's setting up a perfect storm for us because the banks have never been really required to become more conservative. They will be after the housing bubble bursts, but before then they've got I was shocked. The latest profit numbers for the banks came out about 2 or 3 weeks ago, and they've got a different quarter than the rest of the companies usually are December. The banks have they're sort of 1 month off that. They all increased their profits, but the only reason they increased their profits was because they made a drastic reduction in their provision for credit losses, and the provision for credit losses were dropped because they argued that the COVID crisis is over, and therefore we don't have to worry about having any bad debts for a long time. So, and here we are, interest rates are soaring. Everybody's talking about recession. And they're lowering so when you lower your provision for credit losses, that goes directly into the profits of the bank. So the Royal Bank of Canada, for example, took a reduction in provisions of $471 million, which if they hadn't done that, their profits would have been lower this year than last year. So of course they showed a nice increase in profits, and they increased their dividend. So the Canadian banks are very aggressive, as all banks are, to run on a really thin margin of equity so that their return on equity can be as high as possible. And they've been very successful for many, many decades. So who's to argue? I'm the only one that's sort of saying, well, maybe this is not a good way to operate, and maybe you should be more cautious. But it's not going to. The government and the regulators are not going to force the Canadian banks to be more cautious unless and until they get into a crisis over the housing market. And then after that, they will tighten down. And I remember the only real parallel for this period we're in there right now is the early 1980s. So we had tremendous inflation, late 70s, early 80s. And then interest rates went up to 20%. I'm sure you've heard about that. Mm-hmm. And all kinds of people lost their homes, and banks got into real trouble. And that was the only time that there was any comparable to that. And I remember what they did in Alberta was and they had, very much like today, the bankers were more salesmen than they were bankers, right? And so what they did was the salespeople that had convinced everybody to borrow all this money were all moved out of Alberta back to Toronto, or maybe they were let go, I don't know what. And they moved in a bunch of people from Toronto to Alberta that were really good at saying no. And they were like the accountants, right? And it was a complete personality change, and everybody was really upset about the banks, the attitude of the banks being so much tougher than it had been prior to that. And but you can imagine, like, the banker's the one that gave you all these loans, and then now that's he's gone on holidays with you, he knows your kids, he knows your wife, and then he calls a loan on your business so that the business goes under and you have to go bankrupt and lay off all your employees. So that's not going to happen. So the banks have to switch the personnel so the new guy comes in and he can say, I'm sorry, but we're going to call your loan and you put you out of business. And he just doesn't have that personal relationship, right? So yeah, so that's the sort of thing that happens after a crisis. And Hyman Minsky talks about a lot about, I don't know if we talked about Minsky moment last time we did this, but
Yeah, a little bit at the start, but not
that's
not
one of
massive.
the unfortunate things about this is the lenders are very pro-cyclical, which means they're very, when times are good, they're very willing to lend freely. And then when times get tougher, they get really mean and nasty about their loans, and they're not as friendly at all. So they just exacerbate the highs and exacerbate the lows, unfortunately. But that's what's going to happen.
Yeah, yeah. No, my camera just died again. I don't know what's going on with it. Just one quick thing I wanted to ask you. I know I know time is of the essence here, and I don't want to keep you on very longer. I know your time is valuable. Is about Magenta, this lender. Do you think there's any substance to what's going on there? Because they've suddenly come out and stopped, and I've been sent this article about 20 times, and I don't really know what to make of it, if it's anything or not. Much ado about nothing. But
well, I think that the thing to understand, so this is a mortgage investment corp. I looked into it a little bit, and the difference between the banks and the mortgage investment corps is huge. So the difference is that a bank has an ability, when they make a loan, to create money out of thin air. The Bank of England wrote a report on this, and the central bank in Germany also did. Although the Bank of Canada and the Federal Reserve haven't recognized it, but basically the bank has the ability, because they're part of the government charter bank system, that they don't need to actually have the reserves or the deposits in the bank when they make that loan. They just make the loan, and they actually create a deposit. So the loan comes first, and then the deposit happens after the loan is made. And everybody that's taken on a mortgage will know that when they sign the document, all of a sudden this money magically appears. Of course, it disappears just as quick. It goes to the seller of the house. But for a brief moment there, you see this money in your bank account that didn't exist before, and it didn't come from somebody else's bank account. It just was created out of thin air, literally. That's a bank. So now, if you get into mortgage investment corps, it's different. So what they have to do is they have to go to a lender. Often it's just an individual person who gives them $1 million, and then they turn around and give that $1 million to somebody else and lend it to them and charge a 12% interest rate or something, some ridiculously high interest rate, because that person is a high risk borrower because they've got turned down by the bank. So that's a very dodgy kind of business plan, and there's at least two problems with it. One is the borrowers are very high risk. Often they're involved in real estate as builders or other things to do with real estate speculators. And the second thing that's very dodgy about it is they have to keep getting those deposits in from those investors. And if the investors get cold feet, which I'm sure some of them are right now, they don't have a flow of funds coming in, so they don't have any money to lend out. And in fact, some of those people will ask for the money back and say, well, when that loan matures, because the loans, the other thing about the mortgage investment corps is the loans are not 5 and 10 years like they are in mortgages. They're 1 year, usually 1 or 2 years, 2 years at the very most. So when the loan matures, often they would say, oh no, you can just keep the money because they're making 13% interest or whatever. I love it, keep going. But if they get cold feet, then they'll say, well, when that loan matures, give me my money back. Well, as soon as that happens to the mortgage investment corp, their days are numbered, because they can't roll the loans over anymore. So that's probably what's happening there. I don't know. They just said they were suspending new loans until September in the article I read, but that would probably mean that they, when the loans mature, people have asked to have their money returned to them rather than keep putting out new loans. So that's the difference. And those guys, they generally. I asked some of the people in Alberta about these. Alberta's a really big hotbed for this type of loan, and there's lots of private lending going on. And I said, why would anybody pay 13-15% interest on these loans? And the guy that was running it said, well, none of them expect to have the loan for very long. They all think it's going to be, they only need the money for 3 months. It's a 1 year loan, but the difference with that too is they can pay it off with no penalty at any time. So in their mind, they're only going to borrow for 2 or 3 months till they sell that business or sell that house or that whatever, and then they're going to repay the loan. And I said, well, do they do that? Do they, do they pay off the loans for? Well, occasionally they do, but usually they keep the, and then we charge them a renewal fee at the end of the year. So they don't just get 13%. They get another fee, like 3 or 4% renewal fee, but it's more like 16 or 17%. But apparently there's quite a big market for this, and because the difference with those private lenders is they don't ask very many questions about all your, the way the bank wants to go through all your details, what's your pay slip and all that. They don't demand all that information. They just, but they do need the finance from the private lenders, and if it dries up, it's over. Like there's no, and I think probably that's where we're getting to now. A number of them have run into trouble, although it's interesting. It hasn't been in the news much lately, but I'm sure some of the people will be asking for their money back at this point.
Yeah, that's incredibly interesting. Well, I know your time is valuable, Hilliard, so I won't keep you on any longer. Thank you so much for coming on again and sharing all your insights. I thought it was fantastic again.
Yeah, well, I appreciate it. I enjoy this, and of course I do a lot of talking, and I enjoy it. And I would direct people to my Twitter feed there, and also on Fridays I do a weekly note that I write on all. It's not always on real estate. Sometimes it's on the stock market. I'm sure some people on here are interested in the stock market as well. As we can do another whole hour on the stock market if you want sometime. And so I'll just when we hang up here, I'll retweet my this week's post, which came out this morning. It was about the central banks and what they're doing to fight inflation. So it's very short. It's only 500 words. Takes about 3 or 4 minutes to read, and so I encourage people to sign up for that as well. So anyway, it's great to be with you and have these talks, and I hope people get some benefit out of it.
Yeah, and hopefully we can do it again soon. That would be great.
Okay.
All right. Thank you so much, Hilliard, and thank you everybody for being on this stream, and I'll see you in the next one.